Good morning and welcome to Hillrom's fiscal first quarter 2021 earnings conference call. During the presentation, all participants will be in a listen-only mode. At the end of management's prepared remarks, we will conduct a question and answer session. At that time, if you have a question, press star 1 on your touch-tone phone. If anyone should require assistance during the conference call, please press star, then 0. In order to make the call more efficient, please limit your inquiries to 1 question and 1 follow-up. If you have additional questions, you may return to the queue. As a reminder, this call is being recorded by Hillrom and is copyrighted material. It cannot be recorded, rebroadcast, or transmitted without Hillrom's written consent. If you have any objections, please disconnect at this time. I would now like to turn the call over to Ms. Mary Kay Ladone, Senior Vice President, Corporate Development, Strategy, and Investor Relations. Ms. Ladone, you may begin.
Good morning, and thanks for joining us for our fiscal first quarter 2021 earnings conference call. Joining me today are John Groetelaars, President and Chief Executive Officer of Hillrom, and Barbara Bodem, Chief Financial Officer. Before we get started, let me begin by reminding you that this presentation includes forward-looking statements that are subject to risks, uncertainties, assumptions, and other factors that could cause actual results to differ materially from those described, including any impact related to the COVID-19 pandemic. Please refer to today's press release and our SEC filings for more information concerning risk factors that could cause actual results to differ materially. In addition, on today's call, non-GAAP financial measures will be used. Reconciliations between GAAP and non-GAAP financial measures are included in our earnings release issued this morning. Finally, I would also like to mention that in addition to the press release issued this morning, we have posted a supplemental presentation which highlights Hillrom's performance and 2021 financial guidance. These materials can be accessed on the Investor Relations page of our website. So with that introduction, let me now turn the call over to John.
Thanks, Mary Kay, and good morning, everybody. Today we are pleased to announce strong financial results for Q1, and as a result, we are raising both our revenue and earnings guidance for the full year. We started our fiscal year building momentum, accelerating recovery, and expanding demand for many critical care products. This underscores our significant transformation, the diversity of our product portfolio, and strong execution against our strategic priorities. Q1 revenue grew 8%, and adjusted earnings of $1.53 per diluted share increased 35% versus the prior year. We exceeded guidance on both metrics. New product revenue exceeded $150 million, an increase of more than 20%, and we achieved significant operating margin expansion of 260 basis points. We executed on our accelerated business optimization program and advanced our strategic growth platforms with both organic and inorganic investments. We listed several other accomplishments in the press release issued this morning, but none of these could be possible without the dedication and commitment of the entire Hillrom team around the world. I continue to be impressed and proud of how our team members are rising to the occasion to support our global customers and the broader healthcare community. Now, let me provide some perspective on our quarterly financial results before turning the call over to Barb for more detail. For Q1, revenue growth of 8% reflects better than expected performance across all 3 businesses, as the recovery progresses faster than anticipated, along with the benefit of select one-time COVID purchases. At this point, more than 80% of the Hillrom portfolio is showing stable or sequential improvement compared to the fourth quarter. Relative to our guidance, we estimate one-time COVID purchases accounted for about half of the upside, or about $40 million and 20 cents per diluted share, as COVID cases began peaking late in the quarter. We expect to see some ongoing benefit in the fiscal second quarter, although at a more measured pace, given the good news about the declining volume of COVID hospitalizations. The remainder of the Q1 upside can be attributed to recovery of the underlying business as we continue on the path toward normalization. Geographically, U.S. revenue exceeded our expectations and increased 1%, as lower capital revenue like beds and surgical equipment was offset by higher demand for bed rentals and several frontline care products. International revenue increased 19% on a constant currency basis, with double-digit growth across Europe Asia Pacific, and Canada. We are encouraged by the strong execution in these markets as we strengthen our engagement and partnership with local governments and customers while supporting their needs during the pandemic. We are also pleased that our strategic investments in China are paying dividends, with a targeted go-to-market commercial strategy and ongoing recovery delivering double-digit growth for 6 of the last 7 quarters. Now let me turn briefly to review the performance by business at constant currency rates. First, Patient Support Systems revenue increased 8% in Q1, which includes the one-time COVID benefit mentioned earlier. PSS performance reflects the strong international growth of 33%, driven by market expansion of med-surg and ICU bed systems across Europe and other markets. As expected, U.S. bed purchases and care communications revenues were down modestly compared to the prior year, but we continue to anticipate sequential recovery from here. We believe we are very well positioned with our strong value proposition and differentiated ecosystem of smart beds and connected care solutions as hospitals prioritize clinical workflow efficiencies. This continues to be validated by several recent competitive wins, including a 5-year standardization project for Hillrom with nurse call, Voalte mobile applications, and medical device integration across one of the nation's largest healthcare systems. In frontline care, first quarter revenue increased 5%. Performance continues to be driven by double-digit growth in patient monitoring, blood pressure, and thermometry. Physician office-based products, including our vision care and physical assessment tools, also continue to rebound as U.S. physician office visits resume. In our vision care business, we successfully obtained CMS coverage for annual diabetic retinopathy exams in the primary care setting and secured an agreement with a national pharmacy chain to improve access to screenings. Lastly, Surgical Solutions revenue increased 4% in Q1, reflecting strong international growth with the completion of some large projects in EMEA and, as expected, lower revenue for surgical equipment in the U.S. due to access limitations related to the pandemic. As I mentioned last quarter, this pandemic has demonstrated that work we have done to build a strong portfolio will allow Hillrom to uniquely benefit from the accelerated transformation of the global healthcare environment. Hillrom is well positioned to drive meaningful value and deliver our long-range aspirations of mid-single-digit top line and double-digit bottom line growth. We continue to execute on our strategic priorities, including new product momentum and emerging market expansion, while creating value with our business development activities. As you know, on Monday we acquired the contact-free continuous monitoring technology from EarlySense. This digital sensing technology is currently integrated into our Centrella smart bed to help identify clinical deterioration that can lead to improved survival, decreased costs, and decreased need for ICU admissions. By expanding capabilities with Hillrom's connected care ecosystem, we continue to widen the differentiation gap by transforming the bed into a patient monitoring platform that acts as the hub for digital connectivity and communications. Earlier this month, we also announced our intent to acquire Bardy Diagnostics. Bardy is an innovator in digital health and a leading provider of ambulatory cardiac monitoring technologies. The Carnation Ambulatory Monitor, or CAMPatch, provides a differentiated wearable biosensing technology that is designed to promote patient comfort and compliance, streamline clinical workflow, and yield clinically actionable data that enables physicians to identify specific cardiac arrhythmias. There is a clear value proposition, vast body of clinical evidence, cost-effectiveness data, and physician support for this category of devices. That said, we are actively monitoring the situation related to the announced Category 1 reimbursement rates by Novitas last week, and we will provide an update when more definitive information is available. In summary, I'm pleased with our strong start to the fiscal year and how our team is executing during these unprecedented times. Despite the challenges posed by the ongoing pandemic, our customers' continued trust and support for the solutions we provide demonstrates our resiliency and why our vision of advancing connected care is more vital than ever. Now let me turn the call over to Barb.
Thanks, John. and good morning, everyone. I will briefly walk through our financial results before turning to our updated guidance. As mentioned, worldwide revenue in Q1 of $741 million grew 8% compared to $685 million in revenue last year. Revenue growth on a constant currency basis was 6.5%. All three businesses generated higher than expected growth, driven by accelerated recovery trends and expanded demand for critical care products. Adjusted gross margin was 51.2% and expanded by 130 basis points versus the prior year. This was the result of favorable product mix and operational improvements. R&D spending increased 11% to $35 million, highlighting our commitment to drive innovation and advance our portfolio of connected care solutions. Adjusted SG&A of $205 million increased 3%. We continue to fund our strategic growth platforms and IT transformation while managing discretionary spending and realizing planned savings from our business optimization program implemented last year. As a result, adjusted operating margin improved 260 basis points to 18.8%. Interest and other non-operating expenses for the quarter totaled $11 million. This is lower than the prior period due to the benefit of insurance recoveries totaling approximately $5 million or 6 cents per diluted share. The adjusted tax rate was 20.5%, slightly higher than our original expectations due to the geographic mix of our profits. Overall, this translates into adjusted earnings for the fiscal first quarter of $1.53 per diluted share, which is an increase of 35% from $1.13 per diluted share in the prior year. Now, turning to cash flow. Cash flow from operations for Q1 was $100 million, a 30% increase compared to the prior year, primarily driven by higher net income. Capital expenditures totaled $29 million, $5 million higher than the prior year, driven by the continued investment in our global IT transformation. Free cash flow advanced 35% to $71 million. Our balance sheet and financial position remains very strong. In Q1, we returned $70 million to shareholders through dividends and share repurchases. We ended the quarter with $295 million in cash, and our debt to EBITDA ratio at the end of December was 2.7 times, or 2.3 times on a net debt basis. Now, let me conclude my remarks with our updated guidance. Let me start by saying we have not included the impact of the Bardy Diagnostics acquisition in our updated revenue guidance. However, the earnings per share guidance ranges provided today provide sufficient flexibility to absorb deal-related dilution in fiscal 2021 under various scenarios. So, with that said, for the full year, we now expect revenue to increase 0 to 2% on a reported basis, which includes a benefit from foreign currency of approximately 100 basis points. This compares to our prior guidance of a revenue decline in the 3 to 5% range. By business segment, at constant currency rates, we expect patient support systems revenue to decline between 2 and 4%, an improvement of more than 400 basis points from our previous guidance range. We now expect frontline care revenue to grow between 2 and 4% as recovery in the underlying businesses continues. And finally, we continue to expect surgical solutions revenue growth of 3 to 5% with recovery towards pre-COVID levels. From a profitability perspective, we now expect adjusted gross margin and operating margin to be approximately flat to the record levels set in fiscal 2020, with gross margin of approximately 51.5% and operating margin of approximately 18.8%. We expect R&D to approach 5% of sales and expect SG&A to represent approximately 28% of revenue. We now expect other expense, which includes interest, of $65 to $70 million and a tax rate of 19 to 20%. This translates into adjusted earnings of $5.70 to $5.90 per diluted share for the year, roughly an increase of 45 cents per diluted share compared to our previous guidance range, and reflecting mid-teen earnings per share growth after excluding the one-time COVID impacts from both the current and the prior year period. From a cash flow perspective, we are now expecting operating cash flow of $400 million to $430 million, an increase of $30 million compared to our prior guidance. We continue to expect capital expenditures of approximately $100 million, resulting in free cash flow of $300 to $330 million. For our fiscal second quarter, we expect revenue to increase 0 to 2% on a reported basis and adjusted earnings, excluding special items, of $1.40 to $1.45 per diluted share. And now I'll turn the call back over to John.
Thanks, Barb. In closing, while we expect the pandemic to continue to impact the global healthcare landscape in the near term, we remain optimistic about the year ahead and our continued execution on a path toward recovery and normalization. With the diversity of our portfolio, we are well positioned for growth as we navigate this transition throughout fiscal 2021. Over the long term, we remain committed to driving sustainable and profitable growth, achieving our strategic objectives, and unlocking significant value for patients, caregivers, and shareholders as we deliver on our mission. So now I'd like to open up the call for Q&A.
Thank you. We will now begin the question and answer session. If you have a question, please press *1 on your touch-tone phone. If you wish to remove yourself from the queue, press the # key. If you're using a speakerphone, please lift the handset to ask your question. We will pause for a moment while the list is being compiled. I would like to remind participants that this call is being recorded and a digital replay will be available on the Hillrom website for 7 days at www.hillrom.com. First question comes from Rick Wise with Stifel. Please go ahead.
Good morning, John. Good morning, Barb. Let me start with, I think, focusing on two things. One, the better than expected base business performance. And this is sort of a general question, but help us better understand the drivers of that base business improvement. To what extent is it just recovery environmentally in various geographies or execution? To what extent is it new products? If you could give us a little more color there. And maybe just as part of that, John, you could talk about the pipeline you highlighted, you've emphasized in the past, the 10 new products coming in the current fiscal year. How do we think about the impact there as well? How quickly does it help you drive accelerated growth? Is that all fully dialed into your guidance? Just help us understand those two big picture things for starters. Thank you so much.
Yeah, thanks, Rick, and thanks for the question. Well, we're very pleased with the performance in Q1. It's really split between accelerated recovery at a pace faster than we expected, and that's really good news. And it was broad-based across all businesses and across all geographies. So even feel better about that, knowing how broad-based it was across our entire portfolio. So that was about half the driver of our beat versus consensus. The other half came from some COVID benefit. It's important to say that it wasn't a pull forward, but it was rather an expansion of demand that we've been talking about for the last couple of quarters. We've been anticipating and expecting international markets to expand their ICU capacity, and that's exactly what we're seeing out of Europe, particularly in France and Italy in the prior quarter. So I hope that helps characterize the nature of the beat broad-based, more rapid acceleration of recovery, and some COVID benefit, particularly out of Europe on the ICU expansion category. With respect to the growth driver of new products in the second part of your question, new products in the quarter grew over 20% at $150 million for the quarter. So very pleased about the performance of that growth engine and its ability to deliver throughout this pandemic. We saw last year in fiscal 20 that we beat our expectations on new products. Our pipeline is chock full of new launches this year. We have 10 new launches expected, a great number of those happen in Q2. And if you'll recall, Rick, by the time we reach peak revenue of our typical launches, it takes about 2 to 3 years. So what we're really building now is kind of springing the coil to leap us forward into the future because we have so many product launches planned this year. We had 6 last year. We have over 10 this year. And I think that positions the company very well for continued new product performance as we look into the out years.
That's great. And just one quick housekeeping question, just because I think there might be some questions about it. I know you've retired your non-core revenue use of that term with the exit of the international surgical OEM business, but did this quarter complete that? Was there an impact in this quarter, or is that all behind us now? Thanks so much.
Yeah, thanks, Rick. We have retired the definition of core and non-core. However, in this quarter, we did have $11 million of what we would normally call non-core in the revenue number, and that was due to our partner on the surgical OEM side who really requested an additional buy-in of inventory. So that was fulfilled in the first quarter.
Thank you very much.
Next question comes from David Lewis with Morgan Stanley. Please state your question.
Good morning, and thanks for taking the question. I guess a couple things here for me. John, just thinking about sort of the enthusiasm for growth vectors. There's a lot of enthusiasm heading into 2020. I mean, do you think it's safe to say what we're seeing here is those investments with new product growth of 20% and EM traction, you think you can be definitive that those investments are now playing off and your confidence in that 5+% growth is now elevated, or do you think we're sort of putting the cart before the horse?
Great question, David. I think if we break out the COVID impact last year and this year, what we're actually seeing is mid-single-digit top-line growth and 15% EPS growth. And even if we do the similar math and compare 19 to 21 in our new guide, similar outcomes, mid-single-digit top-line, higher than 15% EPS growth. So I think those underlying, to your question, the underlying growth vectors of new products and emerging markets and growth-oriented acquisitions are all delivering throughout this period of time, and feel very good about the outlook there. Of course, as you know, and as all of our investors know, we had a really strong Q3 last year, so we're going to have to cycle past that Q3 comp in a couple of quarters. And then I think the ongoing transparency on a constant currency and reported basis will demonstrate that strength in that top line performance.
Okay, and just 2 more quick ones for me. I'll ask them both together. Bart, for you, and just given John referenced the strong third quarter, there is some historical volatility in the business. Can you just give people a sense of what assumptions you made in this forward guidance this early in the year to give people confidence that this guide still remains risk adjusted? And then John, for you, just on Barty, it sounds like you're confident in your EPS guidance regardless of the outcome with Barty. What are the next steps from your perspective with Barty? Thanks so much.
Thanks, Dave. I'll turn the first part of the call over to Bart to answer, and I'll come back.
Good morning, David. Thanks for the question. If I heard you correctly, what you're looking for is how balanced and achievable is our guide for the remainder of the year. And as you think about the top and the bottom line, as you think about the improvement on revenue guidance for the year, the majority of the roughly $150 million worth of improvement that we've signaled with this guide is coming from our overperformance in Q1. And as John talked about, part of that is coming from one-time COVID, but more importantly, it's coming from the underlying momentum of the business and the stronger than expected recovery. And we will see that momentum play into Q2, which also plays into the improvement as we think about the full year revenue improvement. The other thing I'd flag there is, we have been more explicit about FX and the impact for the full year. And we anticipate that on the top line, we'll have about 100 basis points of benefit from FX on revenue for the full year. So really what we're reflecting is the first half strength of the year, recognizing that, we have very challenging comps in Q3 and we have 3 quarters ahead of us to go. From a bottom line perspective, we are looking at an improvement in our bottom line EPS trajectory of 45 cents, and that really reflects the performance of Q1. What that does is it reserves any further favorability that we would see in Q2 to offset any potential dilution from business development deals, and you should think about it as a floor. So as we've looked at this, we've looked at it very much as, it is balanced and achievable, but it also takes into consideration that we're early in the year and there is uncertainty regarding the pandemic and uncertainty, related to the overall trajectory of where we're going. But we believe that this is, an achievable and balanced view.
And then, David, to your question on Barty, as we said in our opening comments or prepared comments, we're continuing to monitor the reimbursement situation closely. And our guidance contemplates various scenarios that can absorb or cover the dilution that was expected from the Barty deal. So as Barb just mentioned, you can think of this guidance as the floor, in those various scenarios of a different Barty outcome. I'm going to really limit any further comments on Barty going into this call. It's a really sensitive period of time in light of some pending discussions that will likely take place with Novitas and other industry stakeholders. And for that reason, I don't think it's productive to have speculative comments and read into it too much. I would like to say that, given the strength of our business and given the strength of our Q1 performance and our rate and our increase in guidance for the full year, we feel very good about the growth of our underlying business and our ability to meet this increased guidance.
Great. Thank you so much.
Michael Polark with Baird is on the line with a question. Please state your question.
Hey, good morning. I was curious about the 5-year standardization project you called out in care communications. Wondering if you could give us any more color there. Would you name a name? Who is the customer? If not, frame size, number of facilities, total number of beds, perhaps contract value to you over the 5-year term, and then maybe just a little bit of color as you put together that platform, right? Nurse Call plus middleware and Volt. Maybe would be interested in hearing about the sales process there and why you won and what sort of things the customer seemed most interested in. Yeah,
great question, Mike. Happy to answer that. I unfortunately can't mention the name of the customer, but it was one of the largest, one of the top 3 largest hospital systems in the country. And the full end-to-end solution that Hillrom was able to bring in our enterprise ability to scale a solution like that is really what made us well positioned to win. So when I say end-to-end, I'm talking about Nurse Call, the middleware to do medical device integration, which came from our Excel acquisition, and then the Volt or mobile communications that also came through that acquisition of Volt. So that combination of those that full communication suite of digital communications is really what made the difference. And having the confidence and trust that that Hillrom was an organization that could scale that type of deployment over a 5-year period. It would go up there. I didn't have a chance to go back and confirm, but I believe this is our single largest deal that the company's ever done as part of one contract. So it was a big win, and we expect it to provide a nice backlog of orders and future revenue as we recognize revenue over the next 5 years.
Appreciate that. On Barty, I have to ask one. So let's assume you move forward with the transaction. I know that sounds like it's very much TBD, but let's assume you move forward. I understand there is an earn-out structure in the current arrangement. Sometimes when those frameworks are put in place, the acquirer isn't plugging the product into its existing commercial infrastructure right away to let the acquiree, execute against the earn-out. What is the base case in terms of taking the Barty product to your current Welch Allyn, physician office sales force? Is it wait a year or two and let the earn-out unfold, or is the expectation that if and when the deal closes that your sales force would be able to sell that product on day one?
Yeah, our going in proposition there, Mike, was to leave that sales organization to its own and to invest in it, and then separately add the channels that we have in primary care and Welch Allyn to complement it. So that was our approach going in. That is our approach.
Thank you very much.
But again, thanks for the question. I just want to reiterate that our focus is on long-term shareholder value, and in any scenario related to acquisitions or related to the things that are going on in our core business, our overwhelming commitment is to drive double-digit EPS growth and mid-single-digit top-line growth, and we'll manage accordingly in various scenarios.
And Matt Taylor with UBS is on the line with a question. Please state your question.
Good morning. Thanks for taking the question. I just wanted to ask one about the comments that you made on ongoing demand for ICU bed expansion. Going back to last year, there was that big Q3 where you talked about a lot of that being more one time and the ICU opportunities being longer term, but it sounds like that's coming to pass maybe sooner than you expected. So I was hoping you could help kind of square those comments and discuss whether your order book looks good and you're continuing to see strong demand there, and whether we should view this as more one time or the start of a new, stronger trend.
Yeah, thanks, Matt, for the question. What I tried to communicate in the past was that we would probably see that ICU expansion come in lumpy, right? It's going to come in at times in a quarter, and it's going to, come in hot and heavy and feel kind of, like a one time, and then it might be off for a quarter, and then it might come back, quarter after that. So our current outlook, and it's incorporated into our guidance, that we do expect another strong performance out of Europe in the bed category. We see it in our backlog, and we do expect another strong performance out of Europe in that category for ICU expansion requirements. So this will be a couple quarters in a row now where we're seeing it, and it's a little bit hard to predict longer term, say beyond a couple quarters, because just that visibility is not there when the timing is going to happen. However, from a broader aperture or broader time frame point of view over a multi-year period, that growth opportunity is definitely there, we believe. We were hesitant to call it out back in the middle of last year, and then we saw enough data to give us the confidence that it was real, and now we're seeing it showing up in the results. So it will at times come in lumpy. We'll try to give investors a great heads up to when we're seeing it coming, and incorporate that into our guidance. But we see that at this point. We see it obviously in Q1. We see it again a little bit in Q2, attenuating from Q1. And then, we just don't have clear enough visibility to call it out yet in the back half of the year.
Okay. I just had a question on CareCom, so I was hoping you can comment on that specifically in your installation-related businesses. It sounds like that had gone better than you expected in the period. Can you talk about the growth for that and the outlook for installation-based things given continued pandemic stress?
Yeah, so we're very pleased about the deal that we just discussed, and the orders that are coming in. However, from a recognized revenue point of view, CareCom was relatively flat to last quarter, It's gradually recovering and as our access improves, but during the last quarter, access into hospitals, even in the current period, is very limited. So our ability to complete installations and recognize revenue has been stalled. However, as the pandemic continues to wane and hospitalizations continue to drop, we're very optimistic about the back half of the year and seeing that business come back to pre-COVID levels.
Okay, very good. I'll leave it there. Thank you so much.
Thanks, Matt.
Matt Michon with KeyBank is on the line with a question. Please state your question.
Hey, great. Good morning, guys. Just first on RetinaView, I think you mentioned that you signed a deal with a national pharmacy chain for increased screening. Can you talk a little bit more about that channel versus the primary care physician and the strategy for that?
Yeah, thanks for the question, Matt. The whole premise of the technology is to provide better access for patients. So you don't need to see an ophthalmologist to have their annual retinal exam. And putting it in the hands of either a primary care physician's office or, in this case, a retail pharmacy location helps us achieve both the promise of the technology married up with the improvement in the sales channel or the access channel. So this is an exciting opportunity for us. I'm unable to announce who the partner is, but it's one of the largest chains in the country. And we're very pleased about that partnership, and we're in the early phases of rolling that out, and looking forward to a ramp of that activity in the second half of the year.
Okay. Excellent. And then I hate to go back to Bardi, and I realize it's a sensitive period of time. But I'm just curious, the reimbursement decision from Novitas, and you mentioned there's pending discussions there. Is that a final decision, or are there mechanisms in place, to comment or appeal?
Yeah, I think this is a well-covered topic by a lot of the sell-side analysts. So I'm really, as mentioned, I'm not going to we're actively monitoring developments on reimbursement, and we'll provide an update when more definitive information becomes available.
Okay. Thank you, John.
Thank you, Matt.
Mike Matson with Needham is on the line with a question. Please state your question.
Hi, guys. This is Joseph on for Mike. We just won today. I was curious on the cost savings in the quarter from the restructuring. You guys could maybe explain if there was any, how much, and where did that come from? Thank you.
Thanks, Joseph. I'll turn it over to Barb.
Hi, Joseph. Thanks for the question. Hey, what we talked about at the end of last year is that we were triggering a $50 million sort of accelerated business optimization activity. Most of that, over 2/3 of that, was going to be coming from sort of reductions in headcount. So it's going to come more from the comp and ben areas. The balance of it was coming from reprioritization of discretionary spend across the business. So we're on track to deliver that $50 million. It's roughly equal as you think about it over the course of the year. We did realize significant savings in Q1, which we've been, as we talked about last fall as well, reinvested in the business. And we have been spending a lot of time making sure that as we identify opportunities to save or optimize the business, that we're reinvesting it behind our growth drivers and in those levers that we think are going to support our mid-single-digit top-line growth and our acceleration out of the pandemic. So we are realizing the savings. It's pretty equal across the course of the year, and you've got mix now between what is coming from sort of comp and ben and then what's coming from other levers.
Awesome. Thank you very much.
And at this time, I'll turn the call over to the presenters.
Well, thank you all for your questions today. And really was a great quarter and a great start to our year. Momentum is building. We feel very good about the growth drivers that we have been investing in over the last several years. And it's really leading to great margin expansion. and sustainable, durable growth. So we're confident moving forward, and thank you all for joining our call.
Ladies and gentlemen, this concludes today's conference call with Hillrom Holdings Incorporated. Thank you for joining.